Hi, and welcome to the Grove Podcast. I'm Matt Battiali, your host. In these episodes, we try and bring you companies and people and discussions that we at Mangrove Investor feel are important. These are the parts of the business world that maybe you don't see every day. So we try and highlight nonprofits, private companies, and even some public companies, and show you the good that they're doing. So sit back and enjoy this episode, and thanks very much for listening. Hi, I'm Matt Battiali from Mangrove Investor, and today I want to talk to you about the cyclicality of commodity prices. And I know that sounds boring, but it's really, really important to understand if you're going to invest in any kind of natural resource company that's kind of producing goods that are priced globally, like oil, copper, gold, coal, any of those things. But before I get into it, please do me a favor, hit like and subscribe to this channel, and we'll keep bringing you these investment ideas with a sustainable twist. So let's jump into this now. We'll start with oil, and let's go back to 2018. So in 2018, the oil price was around $60 a barrel. It went up to about $76 a barrel. And then when COVID hit and the pandemic locked us all down, the oil price plummeted, and there was a time when it actually went negative. The producers couldn't make any money trying to sell a barrel of oil. In a perfect market, this would never happen because we all knew that we weren't going to stop using oil simply because of the COVID-19 outbreak. But in the short term, the speculators were all betting that oil prices were going to continue to go lower, and the people who were supplying the oil couldn't seem to get a bid for their oil at the time. So oil prices plunged. And that made it a great opportunity to buy oil producers because their prices got absolutely destroyed. And what you saw is as the restrictions were lifted and we all started driving again, there was a whipsaw because particularly among the refiners, we couldn't bring the refining capacity back online fast enough to meet demand. And so demand for oil and oil products soared because you can't just shut oil wells off and turn them back on. They don't work like that. It's not like turning off and on lights. And so then you got this massive whipsaw back to the other side where oil prices were well over $100 a barrel. Gas prices were up over $4 or $5 a gallon, depending on where you lived. And at both ends of this, you see people go on Bloomberg or write an op-ed in the Wall Street Journal and say, it's a terrible time to be in crude oil because crude oil prices are low. And then at the top, it's a great time to be in oil because oil prices are high. And they're wrong. You want to do the exact opposite of that. When the price of oil plummeted during the COVID pandemic, you should have been buying oil. You should have been buying oil producers. You should have been buying refiners. And then at the other side, when oil prices were over $100 a barrel, $120 a barrel, gasoline prices were really high. Everybody's watching what's going to happen with the OPEC. Nobody cared about OPEC prior to this. And then all of a sudden, OPEC is headline news on Yahoo. That's when you know that it's time to start taking some profits off the table. And this is very common. So what you see is the price that the commodity should be, right? And then when bad news comes and you begin to make the trend down. So we know that COVID is happening. It's shutting down shipping. It's shutting down people working and commuting. So the market knows that there's bad news coming for oil. So that's when you get shorts. People say, oh, it's coming. At the point where it's hard to pick a bottom in these things, but typically you will reach a point where everybody knows that oil is a terrible place to be invested, and that's the bottom. And then things start to get a little better, and then they're going really well. Life is returned, the oil market is constrained, everybody knows that we're going to need more oil, everybody knows that there's not enough supply coming in the market. Oil prices peak, and now they come back down. So what you'll often see when I'm writing is when everyone else is euphoric about a commodity, I'm the one saying, whoa, pump the brakes, especially with oil. Oil is a unique market. I've been studying it for a really long time. And what we know about tops and bottoms in oil is that they never last as long as people think they do. I remember in 2008 when everyone was saying that oil prices were going to go to $200, $250 a barrel, and we weren't taking a vacation that year because the price of oil had driven up the price of airline tickets. You couldn't even drive. The cost of a road trip was so high. We just said, we're just going to stay home this year. And I thought, well, geez, if I'm doing that, everybody's doing that. And so I knew that the price of oil wasn't going to stay high. It just couldn't. I mean, at the time, 60% of the oil consumption in the U.S. was through passenger cars, right? That's what we use oil for. It's gasoline. And so if we're conserving, if you and I are conserving, we're not taking road trips and we're not flying to different places, that's going to have an impact. And it's not going to be a major impact, but it's going to be an impact on the margin, which is going to drive down the price of oil $10 or $15, $20 a barrel. And it did. And so we know that oil is kind of constrained within a boundary. There are other situations where the commodity prices are not as constrained. And so I would use palladium as the example for that. So with palladium, I don't remember exactly. I think it's a couple grams of palladium go into every single car that's made. And so the price of palladium isn't material to the cost of an automobile. Palladium goes into the catalytic converter, which cleans up the exhaust, basically, so you don't make the components of smog. It's really important in places like California and New York and Chicago, where you have lots of automobiles. But this is a situation where palladium is not produced commonly. It's difficult to find. There's not a lot of it produced in a year. And during the boom years of 2008 to 2016-17, where China fell in love with the automobile and they made all these great roads and everyone in China were buying high-end cars, the consumption of palladium into vehicle exhaust went up so high that the price of palladium soared, as you can see in this chart. And so what has happened here is that the price of palladium hasn't come back down much because it's being consumed in automobiles. This is a situation where I would be selling palladium. I'm not a buyer of palladium right now, and here's why. China has done a 180-degree turn on automobiles, and now they want everyone to buy electric vehicles. And China is a command economy, and there's an enormous amount of automobile owners there. So you can believe that when China's government says we are switching to electric vehicles, they're going to switch to electric vehicles. So the palladium price went up because it could go up, because even though it was over 1,000% gain in the price of palladium, overall it wasn't a material impact on the cost of a car. Unlike gasoline, where the price of oil directly impacts gasoline, which directly impacts you and I. Like a $2 change in the price of gasoline matters to us, where a $100 increase in the price of palladium to a car doesn't really matter. We're still going to buy that car. Right now, I think you're seeing the same thing going on with lithium. Lithium price has gone up by 1,000%. I think it can go higher because demand's going to go up. But I like copper better. The copper price has been pretty stable over the last 20 years, and you can see in this chart here. But demand is about to soar, and I believe that we're going to see copper take the place of oil here on the world stage in terms of energy, because copper's in everything. We talk about lithium batteries, but the fact is there's more copper in a lithium battery than lithium. So copper is such a large market because it's in so many things. all the goods that we buy, every time we build a house, copper's in everything. We've gotten more efficient with it, but we've had to because it's very difficult to substitute for copper. You can substitute aluminum. It's not as good. It's not as safe. It's not as efficient. But for the most part, if you want to run electricity in something efficiently, it's got to go through copper. So today, I would say I'm not long palladium. I'm probably short palladium, and I'm definitely long copper. So in both of our letters at Mangrove Investor, in the New Energy letter and in Spotlight, we're looking very hard at great copper producers. Because if you like electric vehicles, if you like windmills, if you like solar farms, you love copper. And with our investments, we want to buy companies that are mining for copper the right way, or recycling copper the right way. So that's what we're looking at right now at Mangrove Investor. Thanks again for watching. Don't forget to subscribe to the channel to get more content like this. I'm Matt Battiali from Mangrove Investor. Well, look at that. You made it to the end. Thanks very much for listening. I hope you enjoyed the podcast, and we're going to have a lot more coming. You need to sign up and become part of the Grove. Give us your email address, and we'll make sure you're notified anytime there's a new podcast coming down the pike. Have a great day.